When people think about estate taxes, they usually imagine writing a check out of a cash account or other liquid investments. But here's the problem. A lot of estates don't have enough liquid assets, and the tax bill ends up falling directly on the family's real estate portfolio. Here's what most clients don't realize. If an estate plan doesn't clearly state who pays the estate tax, Massachusetts law has default apportionment rules. That means that the tax bill gets spread proportionately across all the beneficiaries. So if one child inherits the family's commercial building, they're suddenly responsible for a big chunk of the estate tax, even if all they have is brick and mortar. Let's think about this for a second. You can't pay the IRS with a shopping plaza. You need cash. And when beneficiaries don't have it, they may have no choice but to sell or refinance the property just to cover the tax. And this is where things can spiral. A forced sale can ruin long-term plans for the property, and cut off rental income that was supposed to support the family, and even depress the sale price if it has to happen quickly. And for lenders, this creates instability. Loans that used to look great suddenly don't look so good. And for advisors, it means careful planning is needed to preserve both liquidity and the client's intentions. So what is the solution? Smart estate planning, because a trust can allocate who pays the tax. Life insurance can provide liquidity, and advisors can work with attorneys to make sure that the client's portfolio isn't built on assets that might have to be sold in a fire drill. So here's the key takeaway of this video. Estate taxes don't just hit bank accounts. They can force the sale of commercial property if the plan isn't clear. Don't let the default rules decide. Write it into the plan, protect the real estate, and give your clients peace of mind.